Ladies and gentlemen, good day and welcome to Max Estate Limited Q1 FY26 earnings conference call. As a reminder, all participants' lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference to Mr. Sahil Vachani, MD and Vice Chairman of Max Estate Limited. Thank you and over to you, sir.
Thank you and good morning to all for joining us on this Q1 FY26 earnings conference call for Max Estates. Along with me today, we have Mr. Nitin Kansal, our CFO, and Mr. Archit Goel, our Head of IR and SGA, our Investor Relations Advisors. The presentation has been issued to the stock exchanges and uploaded on our company's website. I hope you've all had the opportunity to go through it. Let me first share some industry highlights and then business highlights for the quarter. Delhi NCR is expected to maintain its dominance across the country's top metros in terms of semi-luxury and premium housing demand and supply in the country. Infrastructure advancements, employment opportunities, and increased urbanization continue to strengthen the NCR's housing market in the near to mid-term. The first half of the calendar year 25 proved strong for the residential segment. Ultra-premium homes priced at 5 crores and above continue to attract high-end buyers, with volume sales growing by 9% to 5,200 units approximately in the first half of the year. Across the top 7 cities, Delhi NCR accounted for 65% share of the total premium and luxury sales. Factors such as rising disposable income, aspirational lifestyle priorities, and home buyers scouting for homes with better amenities have kept the demand steady in this region, not to mention the consolidation that we see is continuing. Despite an annual decline in residential sales volume for the first half, real estate developers are actively launching premium supplies with the best amenities and superior construction quality. The share of premium and luxury sales to overall sales has also risen to 27% as compared to 19% previous year. On the commercial front, NCR's office space leasing touched an all-time high of 7.2 million square feet in the first half of the year, up 27% year on year. This makes NCR the second largest commercial office market in the country. Gurugram leads both commercial and residential segments as demand shifts towards premium offerings and global firms expand their footprint. Noida has also caught up well with the Gurgaon market in the first half of the year. Global Capability Centers or GCCs have also expanded their share, growing from 11% of leasing activity last year to 31% in the first half of commercial year 25. Transaction volumes also remain vibrant across major business districts in both Gurgaon and Noida. Noida's expressway corridor and Gurgaon's golf course extension remain magnets for global enterprises that value high construction standards, robust infrastructure, and fantastic ecosystem, and developers with a proven track record of execution. Coming to Max Estates, I'm delighted to share that till date we have recorded cumulative pre-sales of more than 7,300 crores in just 2 years, for which the projects are under implementation. Of this, we have already collected close to 1,800 crores with a collection efficiency of more than 96%. We plan to launch 9,500 crores of new projects or GDV in the second half of this year across 3 projects and across 2 micro markets, 1 in Gurgaon and 2 in Noida, and target of FY26 pre-sales of INR 6,000 crores, which was our original guidance as well, representing 15 to 20% growth over FY25. On the commercial front, we are poised for an annuity rental income potential of over 700 crores over the next 5 years, basis peak occupancy of projects currently in the portfolio. At present, our real estate portfolio stands at 17 million square feet, spanning both commercial and residential asset classes, including projects currently under development. Speaking on the residential portfolio and coming to our projects. First, Estate 128 Noida, both in phase 1 and phase 2, having booked more than 2,700 crores of pre-sales, 100% sold out. We have collected 905 crores till date already. Phase 2 of Estate 128 saw 40% price premium over phase 1, reflecting strong demand for design and hospitality-led end-user focused residential developments and solidifying the brand of Max Estates. Estate 360 in Gurgaon recorded pre-sales value of 4,600 crores approximately, with 98% of the project sold as of 30th of June. The project has already received a collection of close to 900 crores as of June 25. Max Estates joint development in Gurgaon on a land parcel of 18 acres having a potential of 4 million square feet adjacent to the already successfully launched Estate 360 project has a GDV potential of 9,000 crores and is planned to be launched in Q3 of FY26. On a medium-term basis, we target cumulative pre-sales of 21,000 crores by FY28, growing at a 15 to 20% CAGR. Of this, projects which we have already secured include Estate 361 in Gurgaon, Delhi 1 in Noida, and Sector 105 in Noida as well, which contribute about 15,000 crores of this GDV. And these launches planned in FY26 and FY27. Now, coming to the mixed-use portfolio. As we updated, Max Estates has received the final approval from NCLT and NCLAT for the revival of the Delhi 1 project, which is designed to be as a luxury, first-of-its-kind mixed-use development. The project spans approximately 2.5 million square feet within the 10-acre land parcel. The project, planned to be launched in Q4 of FY26, has a gross development value of 2,000 crores as well as an annuity income potential of 220 crores annually. The development of this project will consolidate Max Estates' position as the leading premium real estate developer in Noida and in NCR. In addition to this, Max Estates had acquired a 10-acre land parcel in Sector 105 through an auction from the Noida Authority for 711 crores, which is again a mix of residential and commercial. This project has a gross development value of approximately 3,000 crores and annuity annual rental income potential of approximately 150 crores. This project is also expected to be launched in Q4 of FY26. With this, please allow me to hand it over to our CFO, Nitin Kansal, for a detailed update on the commercial portfolio as also financial updates. Thank you.
Thank you, Sahib. Good morning, everyone. Let me give you an update on the commercial portfolio. Max Towers, Noida, and Max House, both Phase 1 and Phase 2 in Delhi, continue to be 100% leased and occupied, with a rental income of 13 crores and 12 crores respectively for the Q1 of financial year 26. Max Square has also achieved 100% occupancy within a year of its launch, with a recent lease of 23% area to a marquee lessee, Adobe, commanding a 30% premium to the micro market, showing strong leasing traction. Now, coming to commercial projects under design and development, Max Square 2, Noida, project having a leasable area of 1 million square feet is on track and is expected to receive occupancy certificate by the Q2 of financial year 28. The project is expected to yield an annual rental in excess of rupees 110 crores. Max 65 at Sector 65 Gurugram, having a leasable area of 1.6 million square feet, is on track and is expected to receive occupancy certificate in two phases. First phase of 40% by Q2 of FY28 and the second phase by Q3 of FY29 respectively. The project cumulatively is expected to have an annual rental in excess of rupees 200 crores. Overall, our commercial portfolio is poised for an annuity rental income potential of over rupees 700 crores on a 100% basis over the next 5 years. All the developments across WorkWell and LiveWell portfolio are pre-certified to be LEED or IGBC Platinum or Gold ratings with deep focus on best practices of sustainability and health and well-being. We are delighted to also announce that our commitment to end-user experience reflected in how we operate our assets has also earned us the prestigious LEED O&M Well Health and Safety and multiple ISO certifications. With our strong growth momentum and an unwavering commitment to the LiveWell and WorkWell philosophy, creating spaces that elevate the quality of life, we are confident in our ability to emerge as a dominant force in the NCR real estate market, targeting a position among the top 2 brands. Our priorities remain centered on sustaining a healthy balance sheet and generating robust cash flows, enabling timely execution and delivery of our commitments. To give you a financial update on our Q1 results, our consolidated revenues stood at 52 crores in Q1 showing a growth of 27% on year-on-year basis. The consolidated EBITDA stood at rupees 14 crores in the quarter one. Consolidated EBITDA was 17 crores as compared to 12 crores in the corresponding period. Total area leased is 1.2 million square feet across all our commercial assets. Lease rental income across the three assets, Max Towers, Max House, and Max Square, was up 33% year-on-year basis. And the revenue for the facility management arm, Max Asset Services, was 13 crores in quarter one, showing a growth of 52% on year-on-year basis. As on 30th June, the gross debt of the company stood at rupees 1,406 crores with a cash balance of rupees 1,578 crores. We had net cash of rupees 172 crores. Further, of the debt of 1,578 crores, share of Max Estates stood at rupees 837 crores, with the balance of 730 crores representing the share of New York Life in the commercial assets. Now I would like to open the floor for the question and answer session.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashwini Agrawal from Demeter Advisors. Please go ahead.
Hi, morning, Sahil and team. Wonderful updates and results. I had a couple of questions. One is on the commercial portfolio, once the whole thing is rolled out, what is the kind of debt on a consolidated basis that you will have in the commercial portfolio once your full 725 crores odd of rental potential is in operation? And how much of that would be Max Estates share? Any ballpark number?
So thanks, Kishan. This is Nitin. Once we have all the assets completed under construction and the lease rental flowing of 700 crores, our construction finances would have been converted into LRD and our existing LRDs would have got significantly paid down. At that point of time, we would be expecting a number of close to 1,500 crores which would be outstanding, of which our share would be corresponding to 51%, a number close to 750 crores, which you can expect a debt on account of Max Estates.
And is there any money that New York Life still needs to bring in, or they brought in everything? Because now they have 51% across all projects, right?
They got 49% across all.
49%, sorry.
Yeah. So what is happening? They have deployed capital for our commercial assets 65 Max Square and the Delhi 105. There's a small component of across close to 100 crores across these assets which they need to bring in, which they will deploy. We'll do a capital call at the appropriate time as and when the project needs capital. At this juncture,
Sorry, what's the amount that still needs to be called?
Close to 100 crores across all the assets.
100 crores.
Yeah. But having said that, this is a total availability of capital which we have with them. Having said that, parallelly, we have also achieved financial closure on these assets by raising debt. So this capital would be required to be called from, if I'm right, it's in the second or third year from here on.
Okay. And the area that is being serviced by Max Asset Services, there you collected 13 crores during the first quarter. Is all of that just the service revenue, or that includes some development revenue that you're allowed to collect on projects under development jointly with New York Life?
So this is all facility management income. The development manager fees, which is 5%, accrues on the balance sheet of MEL. That doesn't go to Max Asset Services. This is purely on account of facility management.
Okay. Okay. And this is roughly about 35 rupees per square foot per month. Would that calculation be correct?
So what happens is we have got multiple assets. Now we have got facility management charges ranging from 20 rupees to 30 rupees. Depending in the case of Max House, the number might be close to 30, and in case of Max Square, the number would be 20. You can say the average would be close to 25, which would be collecting across the portfolio.
But that 13 number doesn't come, no? Because right now, area that's being serviced is roughly 1.3 million square feet, right?
So the only catch which comes in this is, in addition to the area which we own, there's another, 0.3 million square feet, which is owned by Max Life Insurance Company in Max Towers, in which the income also accrues to Max Asset Services.
Oh, okay. That's a mistake I'm making. Okay. Okay. And the residential portfolio will basically be self-funded by through customer deposits or customer advances.
Yes, yes. In fact, if you see, we have been already able to collect close to 1,800 crores across both the assets which we have launched till date. And we also carry a balance close to 850, 900 crores against both the assets, which is currently in the RERA accounts.
And last question, Sector 105 Noida, the residential portion, is there a minority interest holder there, or that's 100% Max Estates?
So there are in fact three holders in that. We have got Max Estates owns 51% over there. We have got New York Life, and we have got other minority shareholders also, which are in the tune of 7%, and close to 43% is owned by New York Life.
No, but that New York Life would be the commercial part, right? The residential part, they don't participate, or they participate there?
In these two projects, Ashwini, in both, hi, this is Sahil, in both 105 and also Max 1 or Delhi 1, New York Life has a shareholding across the whole project.
Oh, okay. Okay, so whatever other realization that you do from residential sales will go to them as well.
I won't think the revenue, but at the bottom line.
The bottom line.
Yes. After we fund the commercial portfolio there. Yes.
Oh, okay. Okay. Got it. Okay. Thank you so much. Thanks and all the best. Thank you.
Thank you. The next question is from the line of Pritish Seth and from Axis Capital. Please go ahead.
Yeah, thanks for the opportunity. First question is on the demand side. So I think quite an actionable quarter in terms of multiple launches across various developers, and we have seen projects getting absorbed from 50% to even 100%. How do you see the demand, going ahead, Sahil, considering, these uncertainty around tariffs, etc., which might impact certain sectors, etc. So how you see it going ahead? And as per your assessment, what has worked in last quarter in terms of products, etc., which would be a key learning for our projects which are upcoming for us in second half? Yeah.
Thank you, Pritish. So firstly, I think we all live in a very uncertain environment, and it's very difficult to be able to predict the future. Frankly, my guess is as good as yours in terms of how some of the things will pan out with tariffs and the ramifications or outcomes of that. Having said that, what I will say is that for us at Max Estates, we remain very confident because of the following reasons. Number one, if you look at our launches, they are spread over three different projects. In Gurgaon, there's a project and two projects in Noida. Second, in the project in Gurgaon, our launches is we have a section that is for Max Estates and a section that we will sell under the Antara brand. So from our perspective, there are two different product categories, there are two different brands, and there are two different sales networks or channels through which we are selling that. So that's the second. The third is, if you look at it from a size perspective, each launch that we are doing is not more than 350, 400 units per se in each location or micro market. In fact, in Noida, we'll have 290 units. In Delhi 1, we will have 50 units only. And in Gurgaon, we'll have a total of about 450 units. So it's not that the concentration of number of units in each micro market or in each location or in each project is very large. Fourth, what we are seeing, to your question in terms of how we have seen it in the past, is brands who have there is a consolidation trend, there is a shift towards quality, and we believe that at Max Estates we are at the forefront of that with what we have delivered and the kind of confidence that we have garnered. More so that there has been an uplift and even for the price appreciation that people have seen in our projects has been far superior to what the market has seen. So there is an overall added optimism in terms of what we want to do. So if I were to summarize our strategy of having multiple brands, which is Antara and Max Estates, our strategy of not concentrating in one micro market and just one location, our strategy of the number of units in that project, we remain very confident that we will be able to do that. In terms of the larger question on demand, honestly, very difficult to predict the future. Yeah, it's in these uncertain times.
Sure. And just whatever sales you did in this quarter, in terms of your usual conversion cycles, timelines, etc., any marked change there versus what we have usually seen?
Actually, for us, it's been pretty good because we have no inventory left now at all. We've sold everything that we had, and more so for us, the collections have been fantastic. So a key lever I understand is how good collections are. And if you look at our collections, we're at 96-97% collection overall. And the remaining 4% are also that are not due right now. They are due like in the next few weeks. So what is due, we've collected 100%. So our collection cycle has been really fantastic as our numbers are showing. So we are very optimistic and confident that for us, particularly, it's not showing any signs. But like I said, we live in a very uncertain time, and we'll see what the coming months have in store for us.
Sure. And just on the slide on the growth pipeline, quite a few changes that I see on that disclosure versus last quarter. So one, I think Noida, one of the projects which was outright last quarter has been converted to JDA this time. Is it on our discretion of how we want to go ahead, or?
Okay. Yes, absolutely. It's on our decision. And, I think while we are very optimistic and we want to close out opportunities, we are very aggressively pursuing opportunities. We don't want to do that at the cost of financially being imprudent or being too over-aggressive. And therefore, with some of the prices that they work out in the way that they are, and there is sometimes a mismatch if we go out for an outright acquisition, we feel sometimes it may be more prudent from a balance sheet perspective to look at some of those deals through a JDA construct. Having said that, we are still very confident of our continued focus on business development. We have 2 years of pipeline that we have secured. In fact, a little bit more than that. And we are very confident that this is our growth, and we're very confident that we'll add to that for our third year onwards.
Sure. In general, what are the timelines for each stage? Like, how much time it takes for us to reach a final signing from commercial negotiation or a definitive documentation, if you can explain that for our benefit?
So I think from the day we start commercially engaging on a deal to when we close the land, it takes anywhere between 9 months to 12 months, for a full end of the cycle from start to finish. We have had experiences where we've done it in shorter time as well, about 6 months. But we like to take the time upfront to make sure that we don't get caught out on the wrong foot. And because like I said, we are conservative in our underwriting. We are conservative in our diligence, and therefore we'd like to take the time upfront to do that.
So all of these projects would get finally signed in next 9-12 months, is it? And little earlier as well?
I don't think that all of them will, but I think that obviously we are working on, if you see our aspiration, it's to add 3 million square feet of projects. And if you look at the total deals that we are working on around 14-15 million square feet. Right. So the idea is to add 3 million to keep with the growth pipeline that we are doing. So the question is, we have to keep many balls up in the air and have many conversations and many deals and try and select the best one that we feel is in our interest.
Sure, got it. And just one last, I think 2 Gurgaon projects, the size of those 2 projects have also gone up. Is it just expanding the scope with same landowner partner, or these are like completely new projects?
They're separate projects.
Okay.
Yes.
Okay, got it. Thanks. That's it from my side. All the best.
Thank you.
Thank you. Before we take the next question, we would like to remind participants you may press star and 1 to ask a question. The next question is from the line of Ritvik Seth from One Upfin. Please go ahead.
Hi. Good morning, sir. So a couple of questions from my end. Firstly, just continuing the question on the BD, what kind of outlay do we expect to spend in FY26?
So, hi, good morning. This is Nitin. What we're expecting to spend a number in the range of 500 to 800 crores in the BD in the current year.
Okay. Okay. And so this way, do we have cash on hand, like usable cash, excluding the RERA cash
Yes,
of
yes.
this amount?
So as we speak,
Okay.
we have got cash available for closing this funding, and the operating cash flows which should get generated from the existing projects will also help us fuel this growth.
Got it. Also, sure. And so in the last 3 years, we have launched two projects, actually two projects and one more phase at Estate 128 also, where we have seen immediate sales of those projects within few months. So, now seeing the cycle little bit rationalized, what kind of internal estimates do we have, like time period for selling these upcoming three projects for FY 26, Delhi one, Sector 105, and the Gurgaon Sector 36A project? So just trying to get a sense, yeah.
So Ritvik, what we are doing is, if you see now, our target launch pipeline for the current year is close to 9,500 crores rupees. And what we are expecting is giving a guidance of 6 to 6,500 crores. Although in the past, what we have seen a consistent trend across the project that we are able to sell all the units in a very short span of time. But in the current year, we're being conservative about it. In spite of launching 9,500, we will selling close to 6 to 6,500 crores across these three assets.
Okay. Okay. So two-third kind of project sales we are targeting in 6 months itself.
Yes, yes.
Okay. Got it. Got it. And a couple of bookkeeping questions. How much money Max has invested as equity in the commercial projects, in the under construction projects, the two under construction projects till date?
So we would have, in terms of equity, we would have deployed close to 550 crores across these two assets. And which has got corresponding equity share also coming from New York Life.
Right. Okay. Got it. And just on the total debt, is everything related to commercial, or there is some part of residential as well in the total debt?
So currently, all debt is either construction finance, which is for commercial assets, or lease rental discounting, which we have taken across our leased assets. For residential, they are self-funded, and the collection being used is getting deployed in the project itself.
Got it. Got it. Okay. Okay. Great, sir. Thank you, and all the best.
Thank you, Ritvik.
Thank you. The next question is from the line of Ronald Sioni from ICICI Securities. Please go ahead.
Yeah, thank you, sir, for the opportunity, and congratulations on good numbers. Just on the sales front, like you would be having less than 200 crores, right, for Estate 360 Gurgaon, and hence the launch, would be very much critical for the H2. So if you can give us, at what stages these three projects are there in terms of approvals, and where should we expect, RERA to be filed for these three projects?
Yes. Thank you, Ronald. So yeah, we are in building plan approval stages for both our 361 project and also the Max 1 project. And we are going to submit our building plans shortly for our Sector 105 project. So like I said, H2 is the right assumption for us, spread over Q3 and Q4 for these three projects.
And like you mentioned, the number of units to be launched. So in terms of GDV, can you also highlight that? Because some part of it would be launched in FY27.
So the GDV that Nitin mentioned is we are going to be launching about 9,000 crores of GDV this financial year. That's our launch plan of GDV, and our guidance is to be able to achieve 6,000 crores of pre-sales.
So bifurcated into these three if possible.
I think broadly, if you look at it, it will be about 4,000 crores, 4,500 crores for Estate 361. It will be about 2,000 crores for Max 1, and it will be about 3,000 crores for 105.
Thank you very much. And on the Estate 360 front, did we see a flattish kind of realizations, over the last 6 months? Like the run rate is coming around 21,700 odd from earlier run rate of 22,500 per square feet. So are
No.
we seeing a stagnancy?
No, actually, if I can correct you there, please, Ronald. We launched sales in Estate 360 at, if I'm not mistaken, a price of 18 to 19,000 rupees a square foot. And we are currently seeing our last transaction at close to 22,000 rupees a square foot. So in a short span of almost 6, 7, 8 months, it's not a flattish curve, it's an increasing curve. And I just pass on to Nitin. He wants to add to this as well.
Not further to this, what is happening, earlier units had a higher component of PLC which was getting attached to it. So when you saw a net realization, the number would have been higher. These numbers, the base number has gone, as Sahil mentioned, from close to 19 to 22. But because of the PLC not being there on these units, it gives an impression that the realization is less.
Okay. And if you can just broadly highlight on the pricing front, like because most the industry does not expect, more than single-digit hikes this year. So has, the kind of price hikes over the last 2 years which we have seen should be done away with, and we should expect single-digit hikes from here on? And if it is, so is there, some kind of concern in the investor community, especially in the Delhi NCR region, that, would taper down a bit because of low pricing growth environment?
Yes. So, Ronald, what has happened the last couple of years had been an exceptional run in terms of residential real estate pricing, and that was, in fact, that couple of years was more kind of a reflection of what had happened in last 10 years. So it was a kind of a catch-up which was happening for last 10 years in the pricing which happened in last couple of years. Going forward, we don't expect a repeat of same pricing increase to happen, and we would like to underwrite a much more conservative, if I can say, early double-digit kind of growth prices happening in the pricing.
If I can also just add to that, Ronald, I think one of the other aspects here is that we are building communities that are very end-user driven. And while our belief is that we cannot control what happens during the construction period, but we are very confident that when these communities are handed over, there will definitely be a significant price appreciation because of the end user nature of the community, right? For example, in Gurgaon, we have senior living. Senior living is not even an investor-led market, right? It's more an end user-led market. So we have seen that where there is end user occupation is where there will be a significantly better ecosystem to live in, which will lead to, as an outcome, better prices. So just wanted to share that as well.
Thank you very much.
Thank you.
Congratulations again for good.
Thank you, Lee. Thank you so much. Thank you.
Thank you. A reminder to participants, if you wish to ask question, you may press star and 1 on your touchtone phone. The next question is from the line of Raj from Arjav Partners. Please go ahead.
Hello, am I audible?
Yes, please.
Sir, on the ongoing part about 7,589 crores, right? So what are the EBITDA per percentage on which we operate?
Nitin? Yeah, sure. So if you see in our presentation, what we have mentioned is that our current projects have got we have got two classes of assets which are running. One is an outright, which is Estate 128. We have given a guidance with a margin of 40 to 45% in that. And in the case of Estate 360, which is a joint development agreement construct, we have given a guidance of 20-25% EBITDA margins from that. What it translates is that we are looking at an embedded EBITDA of what sales we have done in the range of 2,000 to 2,400 crore rupees as we speak today.
All right. And sir, on the launch part, so we are going to launch around 9,500 crores in H2 FY26, right?
Yes.
So in that, what will be our completion timeline and what will be our EBITDA in it?
So in this, again, what we're guiding is that we would be looking at an outright project. Our guidance is that an outright would have a margins which would be in the range of 25 to 30%. Our launch in Sector 105 is an outright, and in the case of 361, which is a JDA, we would be looking in the margins in the range of 15 to 20%. And our expectation in terms of delivery of these projects would be beginning from FY30 onwards. Starting from FY30, FY31, we would have a staggered delivery of these assets.
All right. And sir, in overall ongoing plus upcoming part, how much of funds will be required to be invested into it?
So if I can break this up in two parts. One which we have got is commercial assets. In the commercial assets, and with partnership with New York Life, we have been able to achieve the complete financial closure, whereby the partners have bought in the equity and the debt has also been tied up with the leading banks. So they are done with. In terms of residential assets, the way we look at it is that we have put in the initial money required to acquire the land through equity, which has been done. And also a capital of close to 200 crores has been earmarked for deployment in these assets before they are launched. Post which the residential projects become self-funded and the collection from customers is used to complete the project.
Okay. All right. Yeah. Okay. Yeah. All right. Thank you.
Thank you.
Thank you. The next question is from the line of Sucrit Patil from Eyesight Fintrade Private Limited. Please go ahead.
Good morning to the Max team and good afternoon to Mr. Vachani. My name is Sucrit Patil and I have a forward-looking question for you, sir. Is that how is Max Estates planning to grow its business over the next 2 to 3 years? And is Max Estates planning to do it by integrating asset-light development models, land partnerships, or platform-led leasing solutions? As urban real estate is shifting towards a more experience-driven, flexible format, and an extension to this, just a hypothetical view, in case if consumption doesn't pick up in India as it is forecasted, is Max Estates ready to bite the bullet and slash the prices and give the premium properties which they are holding at a discounted rate to incur a sale? Yes, sir. Thank you very much. That was my question.
Okay, thank you. Lots of questions, but I'll try and take a few. So firstly, our growth plan, we have very categorically stated in our opening comments, and I'll recap it for a few minutes. Basically, our plan is to grow in commercial and residential real estate in the NCR region. Our plan is to take our commercial annuity income portfolio up to 700 crores in the coming 4 to 5 years. Our plan is to do sales of residential developments of up to 21,000 crores in the next 3 years. So this is the 3 to 5 year plan that we've shared both for residential as well as for commercial. Your second question is with respect to our strategy of being able to go ahead and acquire these land parcels and to sell. As we have demonstrated in the past, we already of this 21,000 crore have a pipeline of 14 to 15,000 crores, which we believe is sufficient for the next 2 years plan that we have outlined. And we will continue to acquire more assets for our third year and beyond that. In our endeavor to do that, we will be looking at outright acquisitions. We will be looking at acquisitions through the insolvency code as we have done through NCLT and CLAT process. We will be looking at joint development agreements, which we have done in the past and will continue to do. And also we look at participating in auctions as we have done in the past. So across all four on the supply side, we look to continue to focus on to acquire. On the demand side, we are very focused on, like I said, the commercial side. We believe that the global capability centers and the demand for office space, given the supply-demand economics for the kind of office spaces that we are creating, continue to be very strong. We are 100% occupied across all our operating assets at a 30% premium to the micro market, and we are confident of this moving forward. On the residential side, as I explained in the previous question and the answer that I had given, is that we are focused across many micro markets in Noida and Gurgaon. We are focused on, multiple projects. We don't have large, number of units per project, and therefore we're very well diversified. We're also diversified because some of our large projects have Antara Senior Living and Max Estates, which is an intergenerational concept that we have pioneered and has done really well for us. Your last question in terms of price drops, I don't see that at all. I think our balance sheets, along with many other listed players, are stellar. We are net debt zero balance sheet. All our residential real estate projects are fully funded from a RERA account perspective, and therefore I frankly don't see a situation of price drops, particularly for the organized and listed and strong real estate developers, and we like to consider ourselves as one of them. I hope that answers all your questions. Thank you.
Yes, thank you. Just for my ending note. So you are very positive that consumption sector will continue in the bullish run, is what your view is, correct? Am I correct?
My view is that for an organized brand like Max Estates, with the strategy that we are following, we remain confident of achieving our targets. I'm not commenting on how the macro can play out or some of the, like I said earlier, very difficult for me to comment on how tariffs and some of these things will play out. But for Max Estates, we remain very optimistic and confident.
Thank you very much. That was a wonderful guidance, and best of luck for all your future endeavors.
Thank you so much.
Thank you. The next question is from the line of Rakshit Gupta from Fair Value Capital. Please go ahead.
Thank you very much for the opportunity and congratulations on a great result. Most of my questions have been answered. Just one question, which is more of a structural question in nature. This is about your commercial real estate portfolio. Looking at the tenant profile, it's super diverse. But I just wanted to ask the exposure to the IT industry, and structurally, we understand that there are certain shifts, such as the slowdown in the US spending, as well as the reduction in the total number of people getting hired in these firms. So do you have any comments about if that shift might also affect real estate developers such as ourselves? And are you seeing any stresses from that already?
Thank you, Parikshit. So we are not seeing any stresses on our portfolio. In fact, to the contrary, we are seeing that there is a supply shortage for grade A quality office spaces, and there's almost no vacancy, including ours. So we are not seeing that at all. To answer your question, from an IT slowdown perspective, frankly, our IT exposure in the overall portfolio is in very low single digits. So we don't see ourselves very highly exposed to that. That's also, frankly, a focus area for us, because I think moving forward, we can do much better with global capability centers and IT to grow. So that is there. I think from a perspective of the clientele that we have a very diverse mix of clientele, right? So we are across BFSI, professional services, law firms, and we are very, very, very well diversified, both in every asset and in the overall portfolio. So in one particular asset, nobody takes more than 20% of the overall building, and in the overall portfolio also, the total industry concentration is at most 20%, and even that is quite diverse within that industry. So I think we feel very confident in terms of our client mix and the diversification that we have to augur well.
Understood. This is super helpful. Thank you again, and good luck for the current quarter.
Thank you so much. Thank you.
Thank you. The next question is from the line of Pritesh Sheth from Axis Capital. Please go ahead.
Hi, Pritesh.
Yeah, hi. Sorry, I didn't realize I was on mute. So thanks for the follow-up. Just one bookkeeping question. What was the construction spend, CapEx spend, and land spend during the quarter? And I think going ahead, it would be just helpful if you can provide us with a cash flow statement stating all these facts. I understand we are still in nascent stage, but I think that those information would be helpful. Thank you.
Sure. Thank you, Pritesh. Going forward, we'll do that. In terms of our spend in the current quarter on the land, we had taken over the Delhi One asset, which had entailed we putting in close to 200 crore rupees for acquisition for the Delhi One asset, and an overall construction spend across all assets should be in the range of 150 crores, which got spent in the current quarter. What we will do.
And construction spend would be both residential as well as commercial, is it?
Yes, both residential and commercial. Going forward, we'll include a table on this subject also.
Sure. Okay, thank you. That's it from us.
Thank you. The next question is from the line of Ritvik Seth from One Up Pen. Please go ahead.
Yeah. So thanks for the follow-up. Just on the residential construction spend, what kind of spend do we expect for FY26? And the collections, we mentioned that we have received second tranche from Estates 128. And what kind of collections we expect for FY26, if you can give us a sense on both these?
Yeah. So in terms of what we have already collected in the first quarter is a number of 360 crores, which is predominantly by the second tranche collection for Estate 128. In the current year, we're expecting another tranche of collection to happen in Estate 360, which would be close to 900 crores. And so in total, we would be expecting a number close to 1,200 to 1,300 coming from the existing project, and a number of incremental 1,000 to 1,200 crores to come from the sales which you see in the current year, a guidance of 6,000 to 6,500 crores. And the total deployment across the assets in terms of construction would be in the range of 450 to 500 crores.
Okay, got it. So approximately 2,000 crores of collections and 500 odd crores of construction spend.
So 2,500 to 2,600 crores of approx collection in the current year, with the 900 crores coming from Estate 360 and close to 500.
Sorry, yeah. Right. And so what would be the fixed corporate overheads on an annual basis for us?
So we have currently the way it is structured is on the corporate overheads are distributed across all the assets. And only the shareholder expenses are housed in the corporate book. As we speak today, the shareholder expenses would be in the range of 25 to 30 crore rupees per annum.
Okay, got it. Okay. And one last question from my end. Sir, any update on the Delhi master plan, any notification that has come up or any progress on that front?
No progress so far. We are also keenly awaiting in terms of any update. We are hoping that with the new government in Delhi, they will look to approve the master plan 2041. So we are hopeful for that, but so far no update.
Okay.
Thank you.
Thanks, Sahil, and all the best.
Thank you very much, Ritvik. Appreciate it. Thank you.
Yeah. Thanks.
Thank you, everybody, for taking the time for joining the call today.
Ladies and gentlemen, that was the last question for today. I now hand conference to management for closing comments.
Thank you for joining the call today and speak to you next quarter.
Thank you. On behalf of Max Estate Limited concludes this conference. Thank you for joining us, and you may now disconnect your lines.